Today is July 29th, edition of Back Roads of Illinois. We were Central Illinois agriculture source, and in the Midwest alongside in Central Illinois agriculture, we were glad you're here on a Monday. Reminder that I will be traveling in and out for this week. However, happy Monday to you guys from us. This time is serious business on the news. Judges hold up to the pork industry. Biofuels call for climate smart. Pipeline battle in central Illinois. A judge uphold with the state of Massachusetts with the pork industry for Massachusetts. Hog producers are concerned about this ruling on the laws in Massachusetts. Similar like Prop 12 in California for the producers. Some biofuels group called for climate smart for the ethanol industry in the Midwest. We're having a discussion about the ethanol production because both of the parties are not supported for the ethanol industry from the campaign trail. The market's a reaction to the campaign trail. Pipeline battle has brewed in central Illinois near Springfield. The state of Illinois has passed the bill to put the pipeline into central Illinois. The CO2 pipeline is going to be starting in South Dakota and Iowa, Minnesota, lastly into central Illinois near Peoria between Springfield. Illinois Farm Bureau and Illinois Corn Growers Association are fighting against it. We were talking with Gil Gillson from Wallace Farmers. Stay tuned on Back Roads of Illinois. We were joining with Gil Gillson from Wallace Farmers in Iowa. It's part of Farm Progress magazine. Welcome to the show. How are you, Gil?
I'm good.
Let's start with our conversation about updating on crop progress in Iowa.
Well,
How
it's
is
been
the crop in central Iowa?
Things are really looking good in central Iowa. The past 10 days or so, it's just been perfect corn growing weather. Mid to high 80s, lots of sunshine, perfect weather for pollination. So things are looking really good. I was traveling across the state last week. I made a trip over to northeastern Iowa, and for the most part, it looked pretty good along the trip. You know, most of the corn is tasseled. The soybeans are canopying. So far, the soybeans look pretty clean. No weed escapes to speak of. But then again, we have August when water hemp can still come on too. So, I talked with a couple of agronomists and they said August is really going to be a critical month, not only for the corn, but also for the soybeans. I think when you get up in northwestern Iowa, I was up there earlier this month, and boy, they just really had a hard time getting hammered with multi-inch rains and flooding. So those folks have really been hit hard. But I think when you get out of that area, the crops are looking pretty good.
Do you have any trouble with the tornado in Greenwood, Iowa?
It didn't hit here where I live in West Des Moines. They're about, I think, 50 miles away. We caught some rain out of that storm, which was just devastating in that area with the property loss and crop damage. When you speak of weather, there was another weather event the middle of July in eastern Iowa. They had another derecho, just winds that knocked over a lot of crop. Kind of akin to August of 2020, but not nearly as damaging. But that storm went into Illinois, and as part of that, it brought some pretty torrential rains to that part of western Illinois. So there have been some pretty tough storms around Iowa this year.
Can you tell our listeners about this growing season in central Iowa for farm progress showing boom?
Well, things are looking just fantastic at the show site. The show manager, Matt Youngman, is talking about they were able to plant corn for field demonstrations on April 11th, and things are progressing very nicely with that crop. So, fingers crossed, in another month, barring any major weather events, there's going to be all kinds of field demonstrations, harvesting and tillage and grain carts. So, things are looking really good. From an exhibitor standpoint, we just wrapped up with putting together the show program last Wednesday, which will hit the farmers' mailboxes about the middle of August. And the page counts, they're up to before pre-COVID levels. So I think that indicates that even with this price slump that we're enduring this summer, there's still plenty of enthusiasm out there. And one thing that's really neat is there's a lot of international visitors who are scheduled to come to the show too. So things are looking great for just a fantastic show from August 27th through 29th in Boone, Iowa.
Gil, farmers does have some concerns about biofuel industry from your reporting.
They do. I was thinking about that. I haven't dove deeply into that subject, but it's one of the things that's on my radar. And one of the things I always remember about biofuels, I was at a meeting with Iowa State specialist, and there was a quote by one at the time, and this was 3 years ago, but I think it still is accurate that as far as farmers who are in their late 50s, early 60s, who are closing in on the end of their careers in a few years, long term, the biofuels, it's going to be there for them. And, taking up a lot of their corn, biodiesel for soybeans. So it's still going to be a player for them. Farmers who are middle aged, that 45 to 50, they may want to look down the road and see if there's any other market opportunities. Biofuels are still going to be a strong part of uses for their crops. But he said one thing kind of interesting for the younger farmers, the 25 to 30 years old, over the course of their career, it's going to change where biofuels may consume less of their product. And I think one thing that highlights that is there's been so much interest in electric vehicles. And I read a series of tweets by Scott Irwin, who's a noted University of Illinois ag economist. And Scott's one of those guys that you can read his tweets, and I always come away smarter than I was before for reading his tweets because he's an astute observer of the agricultural scene. And he was talking about electrical vehicles. And depending on what you read, you think everyone is going to be driving a Tesla in 5 years, or it's just a pipe dream. It's just a big scam. And what Scott was saying, he sees that long term, electric vehicles are going to be common, but it's going to take decades, not years. And he pointed out a lot of major transformations in agriculture, they too take a long time. And I think he gave a really good example. He quoted a University of California ag economist who's dug into this, and it was really interesting just how long it took for tractors to become part of the agricultural scene. Again, decades, not years. And it seems like the tractors, the majority of farmers started adopting them after World War II. And even during World War II, when you think about all the mechanization that was occurring for military purposes, the jeeps, the ships, the tanks, that there were still a lot of farmers during World War II who were planting their crops using horses. So that's just an example that when some new technology comes, it just doesn't come overnight. It takes time, it takes a few decades. And he theorizes that the same thing is going to happen with electrical vehicles, which,
Do you have any final thoughts?
well, I think after, so I know I saw one Facebook friend of mine who had a picture taken of him and his tasseled corn a few weeks ago, and his saying was the corn is tall and the price is short. And I think especially after the price slump we saw last weekend, it really is easy to get discouraged. But these are just normal cycles. That some years when you have a good crop, the price is going to take a hit. And my sense is there's still a lot of working capital left over from the previous years where farmers have made a lot of money. So I think it's just one of those things you have to take in stride. That's just part of farming.
Thanks, Gil. I enjoyed our conversation.
Yes, let's do this again at a future date.
And welcome back to the show. I had a conversation with Adam Johnson from Bullseye in New York about the oil markets for this year. Here's Adam Johnson about the oil markets. And welcome back to the show. Otherwise, we were talking about the economy and inflation for right now. However, we're having a discussion about it with Adam Johnson from Bullseye in New York City. Welcome to the show. How are you today, Adam?
Oh, thank you, Cesar. I'm very happy to be with you. And I'm doing well. I think there's a lot more to like in this economy and the stock market than not to like. So I'm fully invested. You know, the world is imperfect, but we all know that. So we make our best decisions and we go forth every day. And yeah, I'm happy with where we are and where we're going.
Let's start with our conversation about updating from Federal Reserve with the interest rate.
Yeah. So, you know, it's amazing what has happened over the past 3 to 4 weeks, Caesar. We went from sort of thinking, well, there are probably not going to be any interest rate cuts this year to suddenly there's absolutely going to be one in September. And there's going to be another one in November. At least that's what the Fed funds futures market suggests. And by the way, there might even be a third in December. Let's not get ahead of ourselves. But that's just the pivot that has happened over the past several weeks. And it's because inflation has continued to come down, number one. And number two, because unemployment has actually ticked up. And while you hate to see people lose their jobs, the fact is the labor market was very tight and wage inflation was very real. And that had a lot to do with why inflation as a whole was going up. So if you just sort of take the temperature down on the labor market a little bit, you know, the unemployment rate goes to maybe 4.2 or 4.3%, 4.3%. You hope it doesn't go any higher. Right now it's at 4.1. That eases the upward pressure on wages, which helps lower inflation, and all that's good. That justifies rates. Meanwhile, we still have an economy growing 2%, which is solid but not too hot, so that's good. And we have earnings growth of what I think will ultimately prove to be 10% this quarter, and that's very good. So again, it's not a perfect scenario, but there's a lot more to like than to fear.
What is the cut rate for right now?
I'm sorry, just say that again. What is the what rate for right now?
What is the cut rate for right now?
Well, inflation right now is running at about 2.7% if you average all of the indicators of inflation: consumer prices, producer prices, the PCE, personal consumption expenditures, and then finally the GDP price index. Right now, they range anywhere from about 2.4 to 3.1. If you average them all together, it's 2.7%. The target is 2%. And so, some people may listen to that and say, oh gosh, well, 2.7, that's not two. They can't cut rates. Yes, but inflation was as high as 9 to 11%. So it's come way, way down.
Edmund, what happened with the oils markets from the campaign trail?
So oil has been all over the map, as we know, because you and I and probably a number of our viewers look at the futures market every day. But an interesting thing happened to the oil market when President Trump suddenly went up in the ratings, and when it looked like he was more likely to win. And that is because Mr. Trump wants to go back to the policies that were very much a part of his presidency, which was, as they like to say on Wall Street, drill, baby, drill. What happened was he said, drill, baby, drill. You can drill anywhere you like. And then Mr. Biden came in and reversed all that because Mr. Biden had to make a deal with the far left side of the Democratic Party, which wants to further a green agenda. They want to move away from fossil fuels. So Mr. Biden basically put restrictions on drilling on federal land. The problem with that, Cesar, is that a lot of the cheapest, easiest oil to get to is on federal land. So by restricting drilling on federal land, they took out all the low-cost basis oil, and that pushed the price of oil up. So by contrast, you bring in Donald Trump as president, and all that gets reversed. You can drill anywhere you want. And so watch oil as kind of an interesting tell or indicator as to how Mr. Trump is doing. If the market perceives a Trump victory, oil tends to go down. If the market perceives a Democrat victory, no longer Biden, but now Harris, then oil will go up. I know that there are more factors affecting oil than just U.S. politics, like what's happening in Ukraine and Venezuela and Iran, et cetera. But that's certainly one thing for all of us to watch.
What is the prices for right now with baby drill?
Yeah, well, I think that if we get drill, baby, drill back, I should say get Mr. Drill Baby Drill back into the White House. I think you could probably see oil go down to the mid 70s, from the mid 80s, maybe even the low 70s. And if there were actually peace in the Middle East, don't hold your breath, or in Ukraine, you'd probably take another $5 or $10 out of the price of oil. That would put it into the low 60s. So that would be hugely beneficial to our economy because oil touches everyone, from farmers who've got to power tractors to people that need to fly or want to fly, and would bring down airfares, to just driving cars, to gas-powered plants that produce stuff in factories around the country. So bringing the price of oil down 20% would be hugely deflationary, which would be good. You bring inflation down, you would also stoke growth as a result. That would be very positive. So if we get drill baby drill, I see oil probably going into the low 70s. And if we get peace in the Middle East, you probably get it down into the 60s. Right now, oil's in the 80s.
Serious note that President Joe Biden made his plans for the future. What does the bonds markets until November?
Yeah, so the bond market has really been struggling with how to interpret a Trump victory versus a now Harris. We can't say Biden anymore, I guess, but a Harris victory. And here's why. The market is struggling with who's more inflationary. I think it's probably the Democrats, because Democrats tend to spend. And if you have spending, you have, which is what we've had over the past 4 years. We've had the biggest deficits since COVID and World War II under President Biden. So when you have deficit spending, you have inflation, therefore you have higher bond yields. But there's also a theory that because Mr. Trump wants to bring back tariffs on China and introduce tariffs on Mexico, that would raise prices, and that too would be inflationary. So it's possible, Cesar, that no matter who wins, there is some inflationary pressure. But I would counter that by also saying that if Trump wins, we get more drilling, so that's cheaper oil prices. We probably also get tax cuts, and while that could stimulate more spending, in theory, we're going to get less government spending. So there are a lot of moving parts here, and I think the market's struggling with how to interpret all these different it's like a tug of war right now.
How is Dow Jones?
So I am of the view that we are going to see 10% earnings growth by the time the second quarter earnings season is over, which will be in about another 3 weeks. The reason that matters is, first of all, 10, maybe even 11%. That's pretty good. It's double digits. That's historically higher than we've seen. It's also higher than what we saw in the first quarter, which was 8%, and higher than what we saw in the fourth quarter of last year, which was 7%. So 7, 8, and now maybe 10 or 11. Accelerating earnings growth is very strong. The question is whether it can keep going and whether we get, maybe 12 or 13% in the third quarter. I'd like to see that as someone who owns stocks, but I will also admit that there have been some signals that margins are still under pressure, and we may just find that earnings growth tops at 10 or 11%. But if that's all we get for the next couple of quarters, I'm not going to complain, because stocks can keep rallying if we have 10% earnings growth. I mean, they'd rally more if 10 became 12, became 14, became 15, but let's not get greedy. I will say the one thing we really do need is earnings growth, and whether that's 10 or 12 or 15 or whatever, we do need earnings growth, Cesar, because the market right now, the S&P 500, is trading at about 22 times forward earnings, the PE ratio. Historically, in bull markets, you've seen markets trade anywhere from 17 to 20, maybe 21 times. So the current PE ratio of 22, it's a little expensive. That'll be okay if earnings continue to grow. But if earnings don't continue to grow, then we got a problem, which may be one of the reasons why over the past couple of days, markets have been very volatile and kind of trading to the downside. All of a sudden, people are saying, wait a minute, have we gotten ahead of ourselves? And again, as long as earnings continue to grow, no, we have not gotten ahead of ourselves. And I am generally of that view. But it's something that we all need to watch.
Is there anything would you like to talk to our listeners about this growing? Any concerns about world events?
Well, there's been, in terms of world events, what's fascinating about the US stock market is that whenever you get dislocations around the world, like, for example, if you get a military event, when the invasion of Ukraine began, when Houthi rebels struck tankers in the Red Sea, 9/11, the bombing of the USS Cole in the Arabian Gulf. In other words, these hostile events, when they happen, you typically get a 5% correction very quickly, like within 24 hours. But interestingly, over the next week, the markets are back where they were. Something else I've observed, Cesar, is just bringing it back to the US stock market. We have had so far this year 6 corrections of anywhere from 5 to 8% in the NASDAQ. Well, those corrections happen very quickly, but guess what? 2 weeks later, stocks were pretty much back to where they were. So whether you're talking about world events and shocks to the system, or whether you're talking about just volatility in the market, the US stock market is incredibly resilient. So what I would suggest people do is, if they get stressed out by volatility, or if they're feeling uneasy, you can always have a little bit of money sitting on the side. And when you get those 5, 6, 7% corrections, go out and buy and put it to work, because you tend to get rebounds.
It rained on us.
You made a good point in the stock. This time is your commodity markets update on back roads of Illinois. Corn futures finished and down 8 to 10 cents. Soybean futures finished and down 7 to 8 cents. Wheat futures finished and down 4 to 6 cents. Now that we are going to talk about the livestock market for today on back roads of Illinois. Cattle futures finished and down 8 to 9 cents. Feeder cattle finished and down 7 to 4 cents. Thanks to Gil Gillson from Wallace Farmers in Iowa, and thanks to Logan Hartwig from Pope Commodities. We're running out of time on our show, but you can listen to our show on YouTube and whenever you get your podcast. This has been Back Roads of Illinois. I am Cesar Delgado. Have a good day.